Many investors make the same expensive mistake. They find a great company, admire the brand, respect the management, see market leadership, and assume the stock must also be a great investment. It sounds logical, it is also dangerously incomplete because a great business can still be a bad stock if you pay the wrong price. And Maruti Suzuki is one of the best way to understand this brutal market lesson. This is analysis and not any kind of advice. Start with the business. Maruti built one of the India's largest consumer franchisee in automobile. Massive scale, trusted brand, huge distribution network, broad service reach, efficient manufacturing, deep vendor ecosystem, and decades of customer familiarity. These are real advantage. This is why investors historically reward the company with premium valuation. But now ask the harder question. If the business is so strong, why can the stock still disappoints? Because stock return does not come only from business quality, they come from three forces working together: earnings growth, valuation multiple, and time. Even an excellent business can deliver weak returns if earnings slows or valuation was too high when you bought it. Imagine two investors buying the same great company at different price. One buys at reasonable valuation, the other buy when optimism is extreme. If future growth merely becomes normal, the first investor may do well while the second may suffer years of low return. Same company, different outcome. That is the power of entry price. This is where many retail investors get trapped. They confuse quality with guaranteed upside. But markets are not reward system for linking good companies. Market discount future cash flow. If everyone already knows a company is great, that greatness may already be reflected in the price. Then future returns depend on whether reality beats already high expectation. If it does not, the stock can stagnate or fall despite a strong solid business. Now apply this to Maruti. Suppose investors previously priced the company for smooth growth, strong margins, category leadership, and durable confidence. Then margin compress, competition rises, transition became harder, or growth moderates. Even if the company remains strong, the valuation multiple can compress. That multiple compression alone can hurt return significantly. This is why a stock can go nowhere while the business still earns money. The market is not saying a company is worthless. It is saying previous expectations were too generous. Another key lesson: mature leaders often behave differently from emerging challengers. A dominant company may be safer, but because it is already large, growth rate can naturally moderate over time. Slower growth rate justify lower multiple than earlier phases. Investor who ignore this often overpays for stability. Now, does that mean avoid quality companies? Absolutely no. It means analyze them correctly. For value investor, the question is not is Maruti a good company? A question is, at today's price, what return can this company realistically generate from here? That requires estimating future earnings, margins, capital allocation, competitive strength, and valuation you are paying today. This is harder than buying stories, but it is where real investing begins. What should investor track in Maruti specifically? One, earning growth over next 3 to 5 years. Second, margin recovery or permanent pressure. Third, ability to stay relevant in SUV and EV market. Fourth, market share in profitable segment. Fifth, valuation compared with those realities. If growth reaccelerate and valuation is sensible, return can improve. If growth disappoints and valuation remains rich, returns can remain muted. Final takeaway: Maruti may be still a great business, but great business and great stock are not the same sentence. A company becomes a great investment only when future value exceeds the price you pay today. That is why some investors build wealth in quality companies while others merely hold famous name with weak return. In markets, admiration is easy, valuation discipline is rare. And that rare skill often decides who wins. Make sure you subscribe the channel, like the video. See you in the next video. Thank you very much.